Hello, this is Alonzo Hall of ADH Wealth Solutions, and today I've returned with another episode of 10 Cash Commandments. So today I want to talk to you really briefly about, those money market accounts and the different types that there are. So for starters, you have what everybody is familiar with, which is a CD or certificate of deposit. Now, banks usually issue and guarantee CDs with fixed interest rates and minimum values of about 100K. Those are called jumbo CDs. Although face values of $1 million or more are common, most mature in about a year, and some even less, so that they can be traded in secondary markets known as negotiable CDs. Now, only the negotiable CDs are to be considered a money market instrument, and another term for these is jumbo CDs. So the next item on our list is going to be a banker's acceptance, and that's a short-term draft with a specified date, and it's drawn on a bank. So basically, a bank acceptance is a post-dated check or a line of credit. So the payment of that bank acceptance is normally between 1 and 270 days or 9 months. Corporations use these notes extensively to finance internationally traded goods, like buying from a foreign entity. So then the next thing you would have is something called commercial paper or promissory notes. So corporations will issue a short-term unsecured commercial paper or property loan known as a promissory note, and they'll use those to raise cash and to finance accounts receivables, or even hold like seasonal inventory gluts. So when you have a down inventory in your retail, commercial paper, they usually range again from 1 to 270 days or 9 months. Although generally they mature in about 90 days or 3 months. Usually these are given to companies with excellent credit. So the next one is a U.S. Treasury bill, and Treasury bills are going to be short-term debt obligations of the federal government. Okay, they're usually issued weekly, and they have a maturity of 4 weeks, 13 weeks, 26 weeks, and sometimes the whole year of 52 weeks. Okay, so the next one is going to be something they call repos, which is a repurchase agreement. So in a repurchase agreement, or a repo, a financial institution such as a bank or a broker-dealer, they raise cash by temporarily selling some of their assets or their holdings with an agreement to buy it back at a later date at a slightly higher price. So for example, if I sell all my stock right now to somebody and I agree, look, I'm selling it to you at $7 a share, but 270 days later, I'm going to buy it back from you at $8 a share, so that I can have liquid capital right now. And then the next one would be a federal fund loan, and those are Federal Reserve Boards. So the Federal Reserve Board actually mandates how much money its member banks have to keep on reserve, and any deposits that are in excess of those reserves are known as federal funds. So these excess reserves are what's called meeting the reserve requirement, and those funds can actually be loaned from one bank to another for the purpose of meeting the minimum requirements that they have to have for the bank. Literally, these transactions can happen overnight. So with that being said, this was a longer video than usual because I wanted to get everything in there at once. There's still a few more I would go over, but as always, make sure you like, comment, subscribe, share. Look out for my social media. You can always call my 24-hour hotline, 212-470-9932. With that being said, Black Lives Matter, one love. I'm out.